Mark thought he was doing everything right. No accident, no claims, no tickets. For 7 years, he paid his car insurance on time. Every single month. His premium started at $110. By year 5, it was $147. By year 7, it crossed $180. So he called his insurance company and asked the only question that made sense. Why is my rate going up if I've never filed a claim? There was a pause. Then a clean, simple answer. Rates increase due to market conditions. Mark accepted it. Because that's what most people do. They assume that's just how insurance works. But it's not. Because across the office, his coworker Lisa had nearly identical coverage. Same car category. Same city. Same provider. But she was paying $92. Same company. Same system. Same time. The difference wasn't luck. It was one behavior Lisa followed that Mark didn't even know existed. And that difference quietly cost Mark over $6,300 without ever filing a single claim. Most people believe insurance companies make money when accidents happen. They don't. They make the most money when nothing happens. Because the system isn't built on one layer of profit. It's built on many. Hidden. Stacked. And running silently in the background. Mark never saw them. But every single one was working on him. Mark believed something simple. If I'm a safe driver, I should pay less over time. It sounds logical. But insurance isn't priced based on fairness. It's priced based on behavior. More specifically, how predictable you are. The first layer is something called the loyalty penalty. Insurance companies don't reward loyalty. They monetize it. New customers get discounts to switch. Existing customers get gradual increases because they're less likely to leave. Mark stayed for 7 years. Each year, his rate increased just a little. 5%, 8%, sometimes more. Not because he became riskier, but because he became predictable. The second layer, price optimization. Your premium isn't just based on risk. It's based on how likely you are to shop around. Insurance companies track behavior. Do you compare quotes? Do you call when your rate changes? Do your questions increase? Mark didn't. So the system adjusted his price upward. Quietly. Consistently. The third layer. Risk pooling. Even if you never file a claim, you're still paying for people who do. If accidents increase in your area, your premium increases too. Not because of your behavior, but because of theirs. The fourth layer. Coverage padding. Over time, your policy expands. Small add-ons. Extra protections. Features you never actively chose. Mark was paying for services he never used, and probably never would. Then comes the fifth layer. Payment structure. Monthly payments feel easier, but they cost more. Small fees. Processing charges. Convenience costs. Individually, they look harmless. Over time, they add up. But the most powerful layer is something almost no one talks about. It's called float. Insurance companies collect premiums upfront and hold that money before paying any claims. That pool of money gets invested, generating returns while it sits, which means your money is working, just not for you. And then there's behavioral inertia. This is where everything comes together. Most people don't switch insurance, not because they can't, but because they don't want to deal with the process. It feels complicated, time-consuming, unnecessary. And insurance companies know that. They rely on it. Mark stayed. Lisa didn't. That's it. Over time, Mark's premiums increased slowly, almost invisibly. Each renewal, slightly higher than the last. Not enough to trigger alarm, just enough to compound. By the end of 7 years, Mark had paid thousands more than necessary. Not because he made a mistake, but because he followed the default path. Lisa did one thing differently. She treated insurance like a subscription, not a commitment. Every 18 to 24 months, she compared options, removed unnecessary coverage, and if needed, she switched. That one behavior reset the entire system. So what do you actually do? You don't fight the system. You stop playing it blindly. Shop regularly. Review your policy. Question every increase. And most importantly, never assume loyalty saves money. Because in this system, it usually does the opposite. Mark thought he was being rewarded for being safe. But he wasn't. He was being charged for being predictable. If you understand that, you see insurance differently. Not as protection, but as a business. One that's designed to profit quietly. And once you see it, you can't unseen it. If this changes the way you think about money, subscribe to Wealth Logic, because the next video breaks down how banks make money from your savings while paying you almost nothing.